Hey guys, Mike here. So, oh boy, what a red day in the market. And it was funny because banks actually reported good earnings. Like, I think every one of them beat on expectations. And it was like, oh, we're going green. This is great. It started to shift up. And then, shoop, the old rug pull, okay? And so I'm going to actually combine today's video and Sunday's video because I will be out of town Sunday. And so we'll set it up with earnings and economic data and all that good stuff for sure. We'll still do, I'm recording Saturday's video with your comments and questions, all that stuff as well. Just a side note on that. Now, I do want to talk about, I don't think people understand like how important yesterday was and what actually happened in the market at 1 o'clock and these bond auctions and all that stuff. And I'm glad I'm not the only one that was taken aside or taken back by this. And so I'm going to show you a real quick clip of them talking about this, but also why it is important and why you see it happening right now, okay? And really what this means for the economy, the market, that kind of stuff. So I think it's really important to understand this.
What we saw at 1 o'clock today with this Treasury auction, it is remarkably powerful. I had a conversation with Larry Altman, who you know, Scott, and we were questioning each other on when we could remember that type of a catalyst from a auction on the equity market overall. And what that does is it sets up November 1st to be arguably the most important business day of 2023. Not only because what the Federal Reserve is going to do, but what the Treasury Department is going to do. Because on that day, you're going to learn what the supply is for 5-year, 10-year, 30-year paper. And the Treasury Department, like the Federal Reserve, is going to have to step back.
Yeah, Amy, the Fed done.
And so I definitely have that date marked on my calendar, so I'll keep it up to date for us now. And we also have bond auctions coming up, like the 20-year next week, which I'm going to show you the date for that. I think that's going to be another important one. But what really happened was the 30-year bond auction was weak, right? So what does this mean? Well, the Treasury bond auction saw weak demand Thursday amid fears souring U.S. debt will overwhelm Wall Street. The U.S. sold $20 billion of 30-year bonds, but dealers had to take up more supply after investors balked. The soft auction sent yields in longer-dated Treasuries sharply higher. And the reason why this is, and this came out October 11th, America's biggest bond buyers aren't buying. That's what I've been talking about right here, guys. Now it's coming back to haunt us because the U.S. government and China are two of the largest buyers, right? Well, obviously, the Fed, they're running off their balance sheet. They're not a buyer anymore. China's selling right now. And what this means is, I mean, the bottom line, as it says, without these two seemingly bottomless sources of demand for American bonds, Uncle Sam has to offer higher yields than it otherwise would have to get the money it needs from these investors to continue to run our country. So like I've been saying, they need to give them a little more sugar to get them to buy, okay? And so now this leads me into Paul Tudor Jones. He's a legend of Wall Street and stuff, super wealthy guy. And he goes on to say something else, which is extremely important, and this has to do with our deficit. This is where November can come out when you have idiots running up in Washington, don't know what they're doing, running these gigantic deficits.
Or this year, rather, we had $2.3 trillion of funding that the private sector is required to find the funding for. So that has caused a 100 basis point spike in bond yields. In 2024, it's going to be 2.7 trillion in the U.S., 2.7 trillion, almost 10% of our budget is going to have to be to fund our federal spending.
So it doesn't matter what the Federal Reserve says at this point. They've lost control. This is going to be the bond market talking and setting.
Yeah, the bond market. So what's happening is, and why we're probably going to go into recession sometime in the first quarter of next year, probably because the bond market, simply through supply and demand, is going to deliver more rate hikes because we don't have a clearing price yet for long-term debt. And so those rate hikes are probably going to tip us into recession.
And just to give you a visual on this, guys, this is the U.S. government interest payments. Just look at this right here. Well, look at that. That's a meme stock, right? That's interest payments. And so why is this such a big deal long haul, right? Now, it doesn't mean the stock market won't go up, right? But when they say stuff is breaking behind the scenes and you don't know what it is, just look at this right here. This right here is U.S. deficits, guys. Now, I want you to keep in mind, we're supposed to be in good times, right? Not in a recession. And I want you to look over here to the right. That right there is the current deficit. We hadn't even finished out the year yet, but that's the current deficit. Look at what happened. This is the great financial crisis. That was a deficit. That was a horrible recession, right? Then you had the dot-com bubble, another long drawn out recession. You see 2020. When do you notice they're supposed to run the biggest deficits? It's in recessions. And supposedly, if we do go into recession, it's supposed to be first or second quarter of next year if we do. And if we do, is the deficit going to get larger or smaller? It's going to get larger, right? Because that's when the government really has to step in and try to prop the economy up to get it turned around. And this is where, when people keep saying, hopefully we've learned our lesson on this, that deficits and debt, no matter how fast we run it up, don't matter. We can print as much as we want to print because we're American, all that good stuff. And again, doesn't mean the stock market ain't going to go higher because it definitely has its problems, but it puts a strain on the bond market, which is going to, in turn around, could put a strain on the stock market. Okay, does that make sense? Because where do all these companies get their money to run their companies? They're issuing bonds and things like that. Where does the government run off of? Bonds and treasuries, right? They're issuing like crazy. And so if they keep having to up the yields, guess what that's going to put pressure on? Stocks, okay? And plus, it's just not good for future generations, but that's a whole different ballgame right there. What else is this affecting right now? Well, you can see, as he said, those are basically like rate hikes, right? So now in November's meeting, all of a sudden it's almost a 92% chance they don't see them doing a rate hike. All of a sudden this got raised up today to almost 70%. They're not going to do a rate hike in December. That's up from almost like 52%. And so, and of course, what does this lead to when you have higher rates and things like this happening? Well, this is just the loans. Small businesses interest paid on loans, like 10% now. Look how much more it is than it was even when you go back to 2019 at the peak right there. It was like 7 3/4. That is a huge, huge difference. And if these rates stay high and you can't get yields and all this stuff down for a longer period of time, you are definitely going to see stuff cracking. That's just the way it is. There's no way around it. And this is why a lot of people on Wall Street, what are they doing? U.S. Treasury net long positions here, that's zero right there. Everything else is negative below it. And look what they're doing. The 2-year bond and the 10-year bond. That's the 2-year right there. That's the 10-year. And so that's why they're in net short positions right now for a reason. Now, again, when you look at this and take a longer view of this, this is the 10-year Treasury yield. This is now. Look at that going all the way back to the 1980s. And just look at the move up from 2020. That's a crazy, crazy move up. And that's what freaks people out, is the rapid speed at which it does it. And what's going to be even more interesting, and before we continue, guys, please hit that like button there at the bottom. Give it a thumbs up. Helps people find the video. And if you like this kind of content, think about subscribing. I appreciate all you guys' support. As if the Treasury on November 1st actually tries to pull back and not issue as much, that'll be interesting. I mean, that'll kind of definitely tell you something, right? And of course, if it does, that means yields should absolutely tank. And then the market should do what? Move up if they do that. So we're going to pay close attention. Not to mention, like I told you, the 20-year Treasury auction next week. I'll give you the date and time on that one. Now, as far as the stock market day, obviously, when flows turn against you, flows turn against you. All about those options, right? And you saw today what happened here was the biggest negative flows were sitting there on NVIDIA, Tesla, even Exxon right there, Apple, Amazon. And so, options is about liquidity, and then you got the options, right? And if flows start coming in heavy to the downside, that's why I said it goes both ways, then the stocks are going to be under pressure. And if you scroll down here, we'll see it. Meta, Microsoft, AMD got hit hard. Meta was hit hard. And I did this a little earlier, so these are a little bit farther down now. But, when you look at Tesla, it's trying to avoid on the daily here, going beneath that 50 on the RSI, having a bearish MACD cross on the daily right here. We go in the shorter term time frames. And you see right here, I'm going to put in my volume profile. There is a lot of confluence coming down here. If it happens to come down around 250-ish, somewhere in there, you're going to have your moving averages conversion right there. Going to have support. And so, we'll make sure we keep that in mind at that level. So make sure you keep 250-ish in mind. But if we go into a shorter term time frame, you can see, obviously, I'm going to keep those lines in place. And this line was important. I added it yesterday in front of you guys. And you may think, well, what does that mean? This is regular trading hours. If we go to extended trading hours, you can see I said it would be resistance. This is in pre-market. Bam, rejection. And it sold off. Okay, so, when you're looking for stuff like that, you want at least 3 touches. That's kind of the rule I like to go by. And it got rejected. And so we'll go back to regular trading hours. And we'll add in here, because we did get a bounce right there. And when you look back over here, why do we get a bounce? Well, if we put a trend line in here, you can see it's 1, 2, 3. That would be, actually, it would be the 5th time it touched right there. So we'll draw this over here. So that's where we got the bounce. We actually, as I'm recording this, ended up just selling right beneath it right here, but it's trying to hang on to that level right there as I'm talking. And so we'll see if this can get a bounce or not, and things start to pick back up on Monday. And then when we switch over to NVIDIA, you can see I'm actually drawing this one in here. This gives us 3 touches today. That got the rejection. I'm going to see if it starts to wedge in here. And this trend line I just added this morning, it goes all the way back to October of 2022, and you can see multiple rejections. I think it's like 6 rejections of this thing. Then it gets support. Then we get support again. So we'll see if this is going to act as support and just starts to wedge in here. Because again, we're starting earnings ramping up next week for sure. So, we could see some sideways action. Again, it's October, so it's going to be a lot of volatility. Meta, major push down, broke right through what I thought would end up trying to be support, but absolutely not. It ended up going right through like a hot knife through butter as those puts just started rolling in. There is a lot of confluence right here, guys, around that 3 to 304 area. A lot of consolidation. You got your moving averages right there. The 50s flattening out, the 100s moving up. And so that right there will be a hard place for it to get to. If it breaks that, that would be terrible. But it'll be a great place for a bounce. And I'd love to see it get down to that level right there. That'd be absolutely awesome. And then we got AMD, and that supply zone up there is it's tough, man. And then you got the anchor VWAP from the all-time high of 2023. Again, there's your moving averages coming in there as well. It's just a lot of resistance right there, and it bounced off of it, and like a basketball off a goal or something, right? And then you got the MACD. It looks like it's trying to turn over right there, starting to lose some momentum. But again, this is just one big red day for it, small red day yesterday. And so we'll see if it gets a bounce right there. It looks like off the 50 moving average, it starts to move up. 105 is a good place for it to bounce. And then we got Apple, and this is a perfect technical rejection really in this channel. It got saved at the 50 right there. Between 176, 178, decent support. We'll see if this can hold up again. I always say, the market's going to go Apple goes. So if they finally sell it down to the bottom of this channel, it's going to be a rough week next week. Looks like the MACD is trying to cross a 0 line. RSI is trying to hold on right there. We'll see if it can turn back up next week again, get a bounce. Netflix is a hot mess. Again, we talked about this. This is 4 red days. It broke through this channel. It's below the 200 moving average now for 3 straight days. No momentum down there, as you can see. With the MACD, it is an oversold territory. So we can see if we get some kind of bounce off that. But I think, with this one, you look at this right here. There's that gap right there on 343. And so you can just see it filling that gap for sure. There is support there. And so, I think it'd be smart and be healthy for it if it did come down, just fill that gap and see if we can get a bounce up from there. If the market starts to push, don't forget they have earnings next week, as you can see right here. When we pull it up, a busy week next week. Monday, not really much to think of. You got, your regional banks reporting, so people will probably pay attention to that. Tuesday, though, you're going to have a boatload. We're going to sit here with Bank of America, Lockheed Martin, Goldman Sachs, Johnson & Johnson. In the afternoon, United Airlines, Interactive Brokers, JB Hunt, Pinnacle. Wednesday's a big one here. That's ASML, which I think has been on a tear. P&G, Morgan Stanley, Bank Corp. Then you go over and there's the big daddy, Tesla and Netflix. So that will be good. Put in the comments which way you think both those are going. Alcoa, Discover, a lot more regional banks, right? A lot of regional banks next week. So we'll get a lot of data on them. So we will get a lot of data on them. Now, Thursday, AT&T, American Airlines, Taiwan Semiconductors. Then you're going to have Intuitive, Surgical is going to be reporting, CSX is going to be another one people pay attention to. And then on Friday, you're going to end up with American Express and a bunch of regional banks. Now, as far as economic data, it's not too bad. You just got a boatload of Fed speakers. So you got the New York Empire State Manufacturing Index. Not too many people care about that at all. Boatload of Fed speakers coming out, as you can see. And then the next day, we're going to have our retail sales. So that'll be going month over month, year over year. They're actually expecting a decrease in month over month. I think the market would definitely react off this one. Then you have a lot of manufacturing data, a lot of industrial data coming out. NAHB Housing Market Index, people pay attention to that one. And then a lot of more Fed speakers on the 18th, a lot of mortgage data coming out with the permits and stuff like that. I can't imagine it can be that good. What do you think? Housing starts and stuff like that. A lot of oil data is going to be coming out. You end up with a lot more Fed speakers. There's the 20-year bond auction at 1 o'clock on the 18th. So I have that marked on my calendar. We'll see how that one goes. So watch the market at 1 o'clock and see if they have a good one are not so good. All right, and then of course, then boatload of more Fed speakers coming out right there. And then on the 19th, continuous jobless claims, initial jobless claims, the Philadelphia Fed manufacturing stuff. People pay more attention to this because it just seems to be a lot more accurate when it comes to the economy and stuff. Existing home sales and stuff are going to happen. And then when you come down, you actually have Fed Chair Powell's going to speak at noon that day. So watch that on the 19th. Put that on your calendars. And then, I mean, what is it, like 30 Fed speakers or something that week? It's just insane how many are coming out speaking. And then on that, on the 20th, you're going to wrap up with more Fed speakers. And so it has to be a record for Fed speakers as far as I can think, because I've been covering this for a while now. And you can really see why October really is volatile, right? As far as like the percentage swings, because look at all of the earnings. I showed you what we're set up for in October. That's another thing that contributes to it. We just happen to have all the other stuff going on with the bond market and everything else. Contributing to it as well. So anyway, let me know what you guys think, how you think it's going to work out next week and stuff, and I'll end up seeing you guys tomorrow. Do not forget to hit that like and subscribe button on your way out. I appreciate it, and I hope you guys have a great weekend.